Hello everyone, you are welcome to day 2 of this masterclass titled Secrets of Making Money in the Real Estate Market for both old and new realtors. In day 1, the previous class, I exposed to you the different challenges or pain points that you might be going through as a realtor, and I also gave you an overview of what we're going to be achieving or we're going to be learning in the course of this master program. Now, today in day 2, we are moving forward. We're actually going into the course itself. In day 2, we are looking at module 1, step 1. Module 1, step 1. And in this module, we have a number of learning outcomes. What are we going to achieve? What are our learning outcomes in this module? 1, we're going to be looking at the term real estate. We're going to be defining the term real estate so that you can have a clear understanding of what real estate actually means. And secondly, we're going to be looking at the different types of real estate products that we have in the Nigerian market. Now, I need to say this upfront. It is very, very important that you understand and you grasp the full package in this day's module. This is because I discovered that a lot of realtors in Nigeria do not make money because they do not have what to sell, and they do not have what to sell because they don't know what to sell. Your understanding of this module of today's class will give you the opportunity to have at your fingertips a lot of real estate products that you can market. True is the saying that you cannot give what you don't have. You cannot engage clients for what you do not know. So your knowledge of the real estate products that we have in the Nigerian market is what will help you to be able to engage your prospects and be able to make good money. So I enjoin you to pay rapt attention as we go through this program, this course today. Okay, so let's go into the course proper. What is real estate? What is real estate? Now, real estate is defined as the land and any permanent structure like buildings on it. Real estate is defined as the land. What we mean by this is that when we talk about real estate, we're actually talking about the land itself, and any permanent structure, maybe buildings, facilities that are present on the land. That's the core definition of real estate. But for the purpose of this course, I will be defining real estate as a transactional sale or acquisition of real property. Real estate I define as a transactional sale, that's transactional buying or transactional selling of real property. And when we talk about real property, we mean the land itself and everything permanently attached to the land or built on it. So real estate is defined as a transactional sale, that's when you buy, or acquisition, or when you sell of real property. That's for the context of this course, so that you'll be able to align all the things we are going to be discussing with real estate. So real estate is defined as a transactional sale or acquisition of real property. Then in finance, real estate investments are referred to as tangible assets. Real estate in finance is referred to as tangible asset. Tangible because it is physical, it's tangible. You can grasp it. It's a tangible, facilities, tangible assets. So in finance, real estate is defined as tangible assets. Now, what are the various types or classification of real estate investments? What are the various types of real estate investments that we have? As a matter of fact, there are different ways by which real estate is classified or grouped in Nigeria and all over the world. But for the purpose of making money and aiding your sales pitch I will be looking at two main broad classifications of real estate. Now, these two broad classifications are what you need to understand so that when you are marketing, you'll be able to get your client's attention by presenting clear and simple facts to them. These two broad classifications is what will aid your marketing pitch when you are discussing with your clients. If you are, as you are able to grasp these two broad classification of real estate product, it will help you to engage your clients very well. You grasp their attention and you'll be able to present the facts to them in a clear and simple manner. Now, what are the two broad classifications of real estate products that we have? Number one, we have the long-term real estate investments, and then we have the short-term real estate investment. These are the two broad classes of real estate products that we have, and we are going to be looking at them in detail one after the other. Long-term real estate investments. What are long-term real estate investments? As the definition goes, long-term, these are investments with no less than 5 years duration and could stretch for up to 20 years and more. When you have a real estate product that the investment or the tenure is not less than 5 years, we are talking of long-term real estate investment. And for many of them, they could stretch for 20 years, 30 years, 40 years, or even more. You find out that most of the real estate investments that you are familiar with falls under this category. Most of the products that many of us know, they fall under the long-term real estate investments. Now, let's look at them in detail. Let's look at the various types of long-term real estate products that we have in detail. Number one, rental property. Rental property. In this type of product, an investor can choose to own a rental property either through outright purchase of a building or by developing one. What we mean here is this: an investor can decide to own a rental property by buying a building or developing one, building one, and then put it out for rent. Then he begins to collect rental income, maybe monthly, biannually, or annually. That's what we mean by rental property. I know many of us are familiar with this. Somebody has a building or a bungalow and he puts tenants there and begins to collect rent. He could collect rent on monthly basis, could collect rent biannually or annually. Now, what are the advantages of rental property? It is important that you understand the advantages and disadvantages of all these real estate products so that you'll be better informed and you'll be able to advise your clients, your prospects, in the best possible and professional manner. What are the advantages? Number one, it provides steady and regular income stream, which will definitely increase with time. Yes, as I said in the introduction, an investor is able to collect rent on regular basis. It could be on monthly basis, it could be annually. So the rent comes in steadily. That's one of the advantages of rental property. And in addition, this rent will definitely increase with time. It will definitely increase with time. It doesn't remain the same. For instance, maybe as an investor, you put up your property for rent and you are collecting maybe 2 million naira per annum. After a couple of years, you can increase that 2 million to 2.5 or 3 million as the case is. In fact, in Lagos State, by law, you are permitted to increase your rent every 2 years, as the case may be. So an advantage of rental property, it provides steady and regular income stream, which will definitely increase with time. Again, the value of the property increases over time. The value of the property will definitely increase over time. The property you bought maybe at 10 million naira in year one, and then you collect rent for the next 5 years, 10 years. If you are going to sell it, you will not sell it at that initial value that you bought it. You are going to make margin, make interest make good profit on it. Again, there's little maintenance cost involved with rental property, provided the property was in quality shape at the inception. Provided the property was in quality shape at the inception, there's little maintenance cost that is involved. Once the tenants are there, they can continue to maintain the property. Just little maintenance cost is involved, and then again the property can later be sold and good returns earned on it. Just as I said earlier on, you can later sell the property after many years and you still make significant profit. Now, what are the disadvantages involved in rental property? Number one disadvantage is managing tenants. Managing tenants can be very, very tedious. There are some tenants that could be problematic and fastidious. You could have tenants who are very difficult to please, tenants who do not cooperate with other tenants who could be disturbing, both disturbing the community, and all that. So managing tenants for rental property can really be a problem. So we usually advise investors to give their property to professional facility managers. Give the property to professional facility managers to manage the property for you. Again, another disadvantage is that financial stress can occur when an upgrade or repair is needed. This usually occurs when a tenant is replaced. What we mean here is this: should a tenant vacate a property and then you feel the need to want to upgrade, maybe the windows that were there at the inception were louvers, the olden days louvers, and you want to upgrade it to the modern day aluminum casement windows, it could cause some form of financial stress because you did not budget, you did not plan for it. Or maybe the doors are broken, you need to make repairs. So one of the disadvantages of rental property is that it could cause financial stress when a major upgrade or repair is needed. Another disadvantage is reduced income during vacant periods. Reduced income during vacant period. There are sometimes you may not be able to get a tenant to take up the property on time. So for that period where the house is vacant, you are not making any money as an investor. Or also the inability of a tenant to fulfill rental obligation. There are many cases where an existing tenant is not able to pay rent as at when due. This also causes reduced income. The income you are expected, you've budgeted, you've projected to earn doesn't come in. That's another disadvantage of property. Okay, now let's look at some other types of long-term real estate investments. We also have another example here: house flipping. This involves buying a low price property and selling at a higher price after an upgrade or renovation has been done. And I must say that there are many players in this arm of real estate market who are able to turn over their capital and make significant margins. So in house flipping, what happens? As an investor, you buy a property that is low price. Usually properties low price like distress sale, or you buy a carcass and then you upgrade the property, the structure, and then after upgrade has been concluded, you now put it up in the market and you sell at a higher price. And there are so many players, so many investors who do this in the Nigerian market. Now let's look at the advantages of house flipping. Number one, capital is tied up for a lesser period compared to rental property. Rental property, your capital is tied up for a lot of years, sometimes even more than a decade. But for house flipping, the capital is not tied up for so long. Again, it can offer quick returns. Because if you are able to, as an investor, you are able to complete the upgrade, to something more modern, something more eye-catching. You can easily put it up in the market and quickly get a buyer for it. Another advantage is that sometimes the profit margin can be as high as 50% returns or even more. We've seen cases where after the upgrade has been completed and the house is, brought up to modern standard, the investor can put up to 50% profit margin on it. So these are the major advantages of house flipping. Now let's look at the disadvantages. Number one disadvantage is wrong projection can lead to loss of capital. Wrong evaluation of projected income. Wrong feasibility studies can erode capital if sales is delayed. What do we mean by this? If as an investor you have you engage in house flipping, and then after you have completed the upgrade, or let me say before you complete the upgrade, you have done a feasibility study and you said, okay, I'll be able to make 80% returns by the time I'm selling off this property. But if your projection is wrong and you are not able to get a buyer for the property, you find out that you will not be able to make that 80% returns. Maybe you'll be making something less. So when projections are done wrongly, it could lead to loss of capital. The projected income doesn't come in as expected. Another disadvantage is unexpected high cost of upgrade may erode projected earnings. Unexpected high cost of upgrade. For instance, as an investor, you've called your quantity surveyor, they've given you bill of quantity to tell you, okay, this is how much it's going to cost to be able to upgrade this particular property. And then by the time you buy the property and you begin the upgrade, inflation sets in. Cost of building materials have gone up. So this unexpected high cost will definitely erode your earnings at the end of the day. Another disadvantage again is the condition of the property may demand more than is expected to renovate, and it would have been cheaper to buy a finished property. What we are saying here is this: sometimes by the time you check out the property, maybe at the initial stage you decide that, okay, what is needed to be upgraded is maybe the windows, the doors and the roof. And then after you have purchased the property, the upgrade work began, you now discover that it's not only these three things that are affected. Maybe you now discover that the foundation is bad, or the plumbing work is bad, or the electrical work is bad. So the condition of the property, if it's not properly evaluated, could demand more than is expected to renovate, and this will definitely erode your capital as an investor. Now note that for house flipping, it demands that proper assessment of the building and working knowledge of current cost of materials be known. What we are saying is that for house flipping, you as an investor must do proper assessment of the building. It's important that you call in engineers, structural engineers, building engineers, architects that will do proper assessment of the building, so that you have an holistic view of what is needed to be upgraded in the property. And as well, as an investor, you expect to have working knowledge, or know people that have working knowledge of the current cost of building materials. As we know, in Nigeria, prices of goods and materials are not always static. They are not always constant. You could buy a bag of cement today, might be 4,000 naira per bag, and before you know it, in the next 1 week is now 5,000 naira per bag. So before you go into house flipping as an investor, you must have a working knowledge of the current cost of building materials, so that you will not enter into unexpected Okay, now let's look at another example of long-term real estate investment: land flipping. Land flipping, as the name implies, an investor purchases a piece of land, holds it for a couple of years, and then sells it off at a margin. Many individual and corporate players exist in this niche of real estate investment. If the investment is properly and strategically done, the profit margin can be amazing. sometimes more than 1000% returns on investment. We're saying that for land flipping, an investor purchases a piece of land, holds it for a couple of years, maybe 10 years, 15 years, and then sells it off at the margin. There are so many people who practice this in Nigeria, and the returns is amazing. Recently, I bought a piece of land for one of my clients. We bought it at 20 million naira. Just a plot of land, 20 million naira. And then when I asked, before we bought it, when I asked the seller to provide the documents, on going through the document, I found out that the seller actually bought 4 plots, and he bought each plot at the price of 2.5 million naira. So for the 4 plots, he bought it at the price of 10 million naira. Then let's assume he did documentation, governor's consent, perfected his papers, everything. Maybe he paid for a couple of other ancillary services, everything, maybe 15 million. Now he's selling one plot at 20 million. So you can imagine the returns that he's making from that investment. And when I went through the papers, he bought that land 5 years ago. Just within a period of 5 years, he's able to sell at over 1000 naira, 1000% returns on investment. That's how powerful land flipping can be. Okay, let's quickly look at the advantages of land flipping. Number 1, documentation or processing fees are usually cheaper when you compare with house flipping, because there's no structure on it. Documentation and the governor's consent, the title papers, is usually cheaper compared to house flipping. If it is done strategically, it can give very huge return, just as the example I've given you. I also remember a case, I think about a year ago. One of a lawyer friend called me up that he has a client that wants to sell an acre just close to the Lekki Free Trade Zone in Lagos. That's where you have the Dangote refinery. And then he asked me what's the going price for land in that area. So when I did my evaluation, my findings, cost of land in that particular axis was going for 25 to 30 million. And then I told the lawyer, okay, please give me the documents, let me just have a look at it. I going through the document, I found out that the owner of the acre of the land bought the land 20 years ago, and guess how much? He bought it at the rate of 2,500 naira per plot 20 years ago. 2,500 naira per plot. And over the last 20 years, it has appreciated to between 25 and 30 million. So you can see the kind of returns, very huge returns that land flipping can give you as an investor. Again, another advantage is that it has the potential of being transgenerational. It can go from one generation to another. It has a very potent, possibility of being transgenerational. A few months ago, a friend of mine called me that they wanted to sell a property, a family property, and then I also asked for the papers. And when I went through the document, I found that the land itself, though there's a structure on it now, but I found out that the land itself was bought by their grandmother in the 60s, 1960s. And there have been a lot of transfer of rights from one generation to the other. So you can imagine the potentials of land flipping. Your children's children can still meet it, and they'll be able to make good profit out of it. So for land flipping, it has the potential of being transgenerational. Now let's look at the disadvantages. Number 1, it is very prone to loss or takeover. If there's one real estate product that is very prone to loss, it is land flipping. Another disadvantage is that if the location becomes obsolete and not viable, it can lead to the capital tied down for longer period. If that location where the investment, the land is being bought, becomes obsolete and not viable, your capital can be tied down for a longer period because you will not be able to get buyer for it. For example, I remember in Badagry axis of Lagos some years back, a lot of people, a lot of investors were buying lands and properties in that area because the government initially wanted to um, build a railway line from Badagry to the mainland. But after a while, that project became moribund. So people who had projected that in 5 years they are going to sell their property, sell their land, and make good returns, and that was not feasible again because demand for that area has now fallen because that's no longer a viable area. So one of the major disadvantages again of land flipping is that if that location becomes obsolete or not viable, your capital can be tied down for longer period. In Nigeria, investors in land flipping must ensure that they do the following to avoid loss. Number one, you must do proper fencing and gating to show physical possession has been taken. I want to say this: on no account as you as an investor must you buy land and leave it bare without taking physical possession. When we talk about physical possession, we are saying that if you are investing in land flipping, make sure that upon purchase you do perimeter fencing and gating to show that you have taken possession of that land. Number two, get every necessary legal document to secure right over that land. Make sure you get every necessary legal document to secure right over that land. Legal document will mean you must perfect your documents with the government. Maybe if it's governor's consent, if it's CFO, make sure that you have every legal document over that land. And then number three, put a watch or security over that land. Let there be some form of security. Maybe somebody who watches over the land for you, somebody that can give you information from time to time about the status of the land and what's happening in that environment. Please, as an investor, take note of this. Okay, let's move. Now, there are some notes you need to have at your fingertips when you are making long-term real estate investment. So before going into any of these long-term real estate investment, you must ensure the following. Number one, the investment, that's the land or the building, is free from any known government encumbrance. Make sure as an investor that that investment, whether land or building, is free from any known government encumbrance. Number two is that the location is viable and has potential for rapid sale or development. Before engaging in long-term real estate investment, make sure that that location is viable and that it has potential for rapid sale. What I mean by rapid sale is that at the time when you want to sell, you'll be able to sell it. It will not be something that it will be difficult to get buyers for the property. And then also that area has the potential of development. You don't invest in long-term real estate investment in areas that there's no significant development. There are major questions you need to ask yourself. You could ask as an investor, is there a major attraction in that location? Is there a major maybe an industry or a facility or something in that? Is there a major attraction in that location? And you also ask whether there's an existing or a projected government infrastructure that will be coming up in that axis. I remember many years ago, before this Dangote refinery stuff came up, the land began to appreciate in that axis of Lagos because everybody heard that the refinery was coming up. Those kind of investment where that something will be coming up are good and viable areas where you can invest. Again, the security of the investment. Any perceived threat to loss in the future should be given serious consideration, e.g. flooding. You must secure that investment. If you perceive that the investment might be overtaken by natural disasters like fire or flood, make sure that you put in mitigants to ensure that you do not lose your investment. These are three major notes on long-term real estate investment. Okay, let's move on to short-term real estate investment. Okay, these are also referred to as ancillary real estate products. This type of real estate investments usually run from a few months to 2 years, then repeat again. They are cyclical in nature. So when we talk about short-term real estate investments, we are talking of real estate investment that run from a few months to 2 years, and they have the potential of repeating itself again. They are cyclical in nature. Okay, let's look at some of the various types of short-term real estate investment that we have. Number one is property cycling. Here, an investor buys a piece of land or building and resells it anytime within 2 years, sometimes even within a few months. In this type of real estate product, short-term, an investor might buy the land and then hold it for maybe 4 to 6 months and resell again. Maybe the investor buys it in January, holds it for maybe 5 months, June, and then by June puts it up in the market again. There are a lot of players here too as well. I have a client who operates through his lawyer. He just buys a land and then keeps it for just 1 year. After 1 year, he sells. After 1 year, he sells. So this is what we call property cycling. What are the advantages of property cycling? There's quick turnover of capital. You are able to, turn over your capital within a short period of time. Then the risk is very low compared to long-term real estate investment that I described earlier. The risk is very low, and the reason being that you are not holding the property for so long, unlike long-term real estate products where you are holding it for several years. Now, what are the disadvantages? The profit margin might not be substantial. You might not be making so much. Sometimes 10%, 20%, 15% returns on investment. Then it might take longer than expected to get a buyer. Yes, this is one major disadvantage of property cycling. For instance, as an investor, you may buy a land in January, and then in June you put it up for sale. You might be projecting that within a month or two you'll be able to get a buyer, but sometimes buyer might not come for a serious responsive buyer, might not come for 6 months or even more. So disadvantage in property cycling is that it might take longer than expected to get a buyer. Now let's look at another type of short-term real estate product: land banking. This is a recent product in the Nigerian real estate market. It's less than 5 years in the Nigerian market, and it has been given a lot of customized names. You hear people call buyback scheme, land vest, land invest, land pin. There are so many customized names for land banking. Now, what is land banking? Basically, an investor buys land in an estate from a developer, and the developer guarantees to buy it back after an agreed period of time and with an interest margin. What are we saying here? When we talk about land banking, it's a product in which an investor buys a land in an estate, and the estate developer guarantees that after an agreed period of time, the developer will buy it back from the investor with an interest, at an interest margin. That's basically what land banking is all about. The period can be 6 months, can be 10 months, can be 9 months, can be 1 year. For instance, the developer might agree to buy it back at 25% interest in 6 months, might agree to buy it back at 40% interest in 10 months, might agree to buy it back at 50% interest in 12 months. So this is how land banking actually operates. Now, as an investor, you approach an estate developer who has this product, and then the terms are discussed. In 6 months, I want to invest this amount of money, and then the rate is negotiated: 25% interest rate. Now there are a number of mitigants or collateral, so to say. When, as an investor, you invest in land banking, you'll be given a number of documents. Number one, you'll be given a contract of investment. The contract of investment spells out all the terms and conditions of that contract. It's a document, a legal document between the estate developer and the investor. Number two, you also get an acknowledgement letter that acknowledges that a certain amount of money has been paid for this particular product. And then number three, you get post-dated check. Post-dated check, this post-dated check will cover your capital and the interest accrued, and the post-dated check is expected to mature after the agreed period of time, whether it's 6 months, 10 months, or 12 months. I hope we understand that. Okay, let's look at this flyer. Okay, look at this flyer here. This is one of our partners, that we sell their land banking product. Theirs is called buyback scheme, and you can see there, buy one plot at 1 million and sell for 1,250,000 in 6 months. Buy one plot at 1 million and sell for 1.4 million in 10 months. Buy one plot at 1 million and sell for 1.5 million in 12 months. Now, what this is saying is that for the 6 months, it's 25%, for 10 months, it's 40%, and then for 12 months, it's 50%. This is an example of a land banking flyer. Now, what are the advantages of land banking? Number one, it offers guaranteed returns after an agreed period of time. The returns is guaranteed. The interest is guaranteed after an agreed period of time. Number two is that it solves the problem of sourcing for a buyer and the associated waiting period. It solves the problem of sourcing for a buyer. As I said in other real estate products, when you put up the property, the land for sale, you need to source for a buyer, and sometimes sourcing for a buyer can take time. So what land banking does is that it solves that problem. You don't need to source for a buyer, and you don't need to wait. Once the tenure has matured, you cash out, you get your returns. Another advantage is that the issuance of post-dated check legally binds the developer to the investment contract. As I explained, some of the documents that are made available during land banking is a post-dated check. And a post-dated check is a legal tender in the sense that it automatically binds the developer to the investment contract. The check can be tendered in court, as an evidence, that the transaction actually occurs. So the issuance of a post-dated check legally binds the developer to the investment contract. Now, what are the disadvantages? Inability of the developer to fulfill obligation when due. This could arise from mismanagement of funds. We have seen a lot of cases where a developer is not able to fulfill that obligation when it is due, and most of the time it is because of mismanagement of funds. The funds have been diverted to, most of the time, personal use. Then again, the land used as collateral may have legal issues and may not be easily called in should there be a breach of contract. Now, the land that the investor has bought, if there are issues and the land and you need to call in the land, if that land has legal issues, maybe the ownership is contended, or one thing or the other, that collateral, that land cannot be easily called in. That's now joint venture, JV. This is another real estate product entirely. I know many of us have heard joint venture. What is it all about? Now, a real estate joint venture is a deal between two or more parties to work together and combine resources to develop a real estate project. Once again, a real estate joint venture is a deal between two or more parties to work together and combine resources to develop a real estate project. Big real estate projects are usually financed and developed through joint venture. Very big real estate project, skyscrapers, big real estate projects are usually financed and developed through joint ventures. JV provides an avenue for real estate operators. When we talk about real estate operators, we are talking of individuals or companies who have significant experience in managing real estate projects to work with real estate capital providers. Capital providers are entities that have the capacity to fund real estate projects, whether in cash or kind. So JV provides an avenue for real estate operators to work together with real estate capital providers. Now, who are the players in a joint venture? Who are the parties to a joint venture in the Nigerian context? I am very specific about mentioning the Nigerian context because what we have in Nigeria is slightly different from what we have in other parts of the world. Now, number one, you have the landowner. This is the party who possesses legal rights to the land intended for the real estate project. One of the parties to a joint venture in Nigeria is the landowner, and that's the party who possesses legal rights to the land intended for the real estate project. And then number two is developer. This is the party, usually a company, who possesses the financial capacity and expertise needed to execute the real estate project. So in Nigeria, we have two players in any joint venture deal. You have the landowner, who is the person who possesses the legal rights to the land intended for the real estate project, and we also have the developer, who possesses the financial capacity and the expertise needed to execute the real estate project. Now, this is a slight deviation from global practice. Outside Nigeria, what usually occurs for a joint venture, you have parties that come together, a party that has the financial expertise, and then another party that develops the property, that develops the project. One part provides the finance, another part provides the development. That is usually what we have outside the country. But in Nigeria, we have two major players in a joint venture deal: the landowner and the developer. Now, in Nigeria, the real estate market has two forms of joint venture agreement. There are majorly two forms of joint venture agreement in Nigeria, and I'll be looking at them in two cases. So case one, the two parties agree on the number of units or structures that should be developed on the land. For instance, on a land of say 3,000 square meter, the two parties come together and they agree that, okay, we are going to be putting up terraces, we are going to be putting up duplexes, we are going to be putting up bungalow, we are going to be putting up block of flats, and then they will also agree on the number of units that should be on the land. They might say, okay, we need 8 units of 3-bedroom terrace, or they might say we need 10 units of 2-bedroom apartments in a block of flats. And upon agreeing on this, a sharing formula is further deliberated and agreed upon by the parties involved. They can agree that, okay, we are putting up 8 units, we are going to share it in this ratio: 5:3, 4:4, 3:5. A party will go with 5 units, another party will go with 3 units, a party might go with 4, the other party goes with 4, a party will go with 3, another party goes with 5. That is case 1. Now, the sharing formula depends on a number of factors, such as 1, the value of the land. What's the value of the land? What's the cost of the land? Projected estimated value of the land. Number 2, what's the overall cost implication of the project? How much will it cost to start and complete the project? And then number 3, what's the estimated market value of the project upon completion? By the time the project is completed, what's the expected market value? What's the expected income, projected income? These 3 factors determine the sharing formula in this case of a joint venture agreement. When a final agreement is reached by both parties, a joint venture contract is executed, binding both parties together. Okay, that's case 1 of the forms of joint venture agreement that we have in Nigeria. Now let's look at case 2. The two parties agree on the type of structure and the number of units to be developed on the land. The landowner gives the developer an agreed number of years to manage and operate the property, after which the developer hands over the management and full ownership to the landowner. In case 2, what we mean here is this: the two parties agree together. They say, okay, on this parcel of land, we are going to be building block of flats, or we are going to be building terraces, or we are going to be building mini flats on this land. And then the landowner now agrees to hand over the management and operation of the property upon completion to the developer, and they can agree on the duration, the number of years. The landowner can say, okay, after you have completed this project, you would manage it, you operate it for the next 10 years, you operate it for the next 15 years or 20 years. They agree on the duration. So for that 15 or 20 years, as the case may be, the developer manages and operates the facility, the project. He collects the rent, he does the management, he does everything for that period. And after that period expires, the developer hands over the property, the project, back to the landowner, and the agreement is terminated. That's case 2. Now, the developer could manage the property for up to 20 years in some cases. This form of JV is the conventional type and practiced decades ago in Nigeria. It is gradually giving way to case 1 initially described above. This form of JV is what they used to practice decades in Nigeria, decades ago in Nigeria. It's gradually giving way to case 1. It's not as common as case 1 again. Now, the downside of this type of JV is that should the years be prolonged and the landowner dies, the developer usually ends up taking perpetual ownership of the property. That is the downside. There are a lot of cases where before the expiration of the agreed duration, the landowner will die, and then the developer just takes up the property, continually. So that's the disadvantage of this case, this type of joint venture deal. Now, in summary, we have looked into detail into the various products that we have. And remember, I said at the introduction that it is very, very important for you to get a mastery of all these real estate products that we have in Nigeria. It will help you a lot. It will help you a lot. You'll be able to engage your clients. You'll be able to have product to sell, a lot. So in summary, it is very important for you to absorb and fully understand all these types of real estate investments that we have in Nigeria. Your understanding of all these products will guarantee steady income flow into your bank account. Your ability to discuss with your clients all these products will display your expertise and foster confidence and trust in you. Clients prefer to do business with realtors that show they know their job and understand the real estate market. And nobody wants to deal with a novice. Nobody wants to deal with no client wants to deal with a realtor that doesn't understand, doesn't know their products very well. So I want to encourage you to still find time, go over this particular module, write it down, absorb it, so that when you are engaging your clients, you'll be able to have an array of products to market. And there's no how, as a realtor, you will know all these products, that you will not be able to have something to engage your clients with. So it is very, very important for you to absorb and fully understand all these types of real estate investments that we have in Nigeria. Okay, activity time. This is your take-home assignment. Number 1, what are the advantages and disadvantages of owning a rental property? Mention as many as possible. Number 2, which type of client will you pitch land banking to? What are the major advantages or selling points of land banking? And then number 3, basically, we have 2 types of joint venture transactions in Nigeria. Which one will you prefer as an investor, and why? I expect you to do this assignment, send it back to me on our email, on our my email address in the body of the email that was sent to you. Send it so that we can review you. I want to see that you understand what we have discussed in this particular module. So thank you for staying tuned. In our next lecture, we'll be going deeper. So stay tuned as we go forward in this course. Thank you. Have a great day.